Vin says, hello. Hello, Vin. How are you? He says, market sentiment. Can you explain, because can we use it as a tool to trade short term? Yep, we'll get to the market sentiment in a moment. And then, Vin, after that, you wanted to know about weekly naked puts could be used as potential buys to go long of stock. Not really, but we'll talk about that in a moment. Just 1 second, ladies and gentlemen. So let's get to the Home tab. The Market Sentiment Tool is a tool that shows us 13 different broad-based indicators that Ernie compiled and tested over time to see effectively when certain trends, certain conditions, certain things are met, is it indicative of a change in the market, a sell warning, a buy warning, a decline, and so forth. So let's go ahead and click on View Indicator Details. And here we can go through briefly the 13 different indicators. The total market put-call volume ratio is currently in a bearish mode based on the fences. What are the fences? When you click on the details here, it shows you at various times the highs and low ranges of the put-call volume ratio. And then you can see here the histogram. So typically when we're at a low range of the put-call volume ratio, in this case we're at about 0.53, it was the last value, we typically don't see it go further. So the put-call volume ratio would have to increase. What's going to cause that to increase and go back into the normal mode as it's in bearish right now? Well, the put-call volume is going to change. So usually just over the course of time, you expect it to revert back to the norms, which would be going to a higher number of the put-call ratio as well. Of course, when you see it here, that would be more of a bullish indicator when it's above 1, as the puts are extremely higher than the calls as well. Some of our other indicators we have, of course, SPX number of days up, SPS gap over SMA 20, percentage of stocks over SMA 20, percentage new stock 52-week high and low, volatility index. The trend is actually in a bullish indication. That's kind of interesting. The RSI of the underlying SPX. Number of days the SPX is over its SMA 20, that's in bearish. Number of days it's over the SMA 100, that's bearish. The size of the gap over the SMA 100, that's gone bearish. Percentage of stocks over SMA 100, that's gone bearish as well. So when these things, obviously you can see, are hit, that usually means that there's bound to be a retracement that comes along as well. Okay, so when we're looking at this screen, and we see here that we're in a sell warning and it's pulled back slightly, only 0.4%. The idea is that when you have 4 or 5 bearish indicators set, which you may have 2 bullish and, let's say 6 neutral, whatever it is, but when you start to get into the 4, 5, and 6 range, that's when the sell warning is triggered. Okay? And it's an indication that some of these fundamental and technical criteria are overextended and likely point to a pullback in the market, which would be shorter term. Now, I believe we discussed this a week or so ago. I don't recall if it was direct. It might have been just on a coaching session. But last week, we started to see the sell warnings start to trigger. Okay, let me just make this a little bit bigger. So I'm just looking at some of the history here. Right around July 20th, you see we're at 32.51. The first sell warning triggered, we were at 4, and then it went up to 5. Sorry about that, and then was stuck at 5 here. Now, this started at 32.51, and the market kept going up, and it went up here, and then it pulled down. Right? So the third sell warning is at 32.76, dropped down to 32.35, and then went to 32.15. Went up, went down, now it's back up again, and we're starting to see the sell warnings. So what occurred with this is that a couple coaching sessions, and I believe a gentleman on a phone call or email had said at this point, I'm seeing the sell warnings triggered. Should I close out of my covered calls? Should I start buying puts? And what we typically wait to see is the next level. So when I get 3 or 4 sell warnings in a row, when the next darker red one comes up, a bearish sell warning, that's when I'll start to look to pick positions, to close maybe my bull put spreads if I'm at a profit, to maybe adjust covered calls, for example, to get a little bit more protection. maybe to add an extra put in that case to a married put position, what we call income method number 12. I might do that in the radioactive trading techniques. Okay, so that's when I would prepare, not necessarily get out of the position, but to look for a little bit extra insurance, maybe buy calls on the VIX, okay? But the customer asks, well, I've seen these 3 sell warnings, shouldn't I do it now? Well, let's look at the biggest drop that happened. And if my math serves me correctly from the last time I had this discussion, the peak recently was at that 32.76, and the low was at 32.15. It did ease off, sort of like releasing the pressure valve in a sense, but that's only 60 points, which I believe came out to 1.5% total of a decline across the broad market. And this day was about a 0.75 decline, it dropped down about 40 points. And this was about, same thing, 0.75 dropped another 25, 30 points. That's almost in the noise, isn't it? That's not a really big pullback. It's letting you know that these indicators, number of days the SPX is up, number of days it's gapped above the SMA 20 historically, usually at this time point to a decline. But what I was waiting for is that deeper red at the 6 or 7 bearish warning, where we see a strong bear sell warning, for example, along those lines. And they didn't see it. If I had closed my bull puts here, or if I had bought puts on SPY or SPX, I wouldn't have seen a lot of profit. It might have come out to be a wash, just what I lost on, say, stock holdings or bull put credit spreads, but I didn't lose on the bull puts. They were still 3 or 4 days to expiration, and they expired worthless. It would have been an overreaction in this case. This is more of a shorter-term indicator. It's not pointing to something 6 months out in time, Vin, and I know that's not what you were asking. But if I start to see the bearish sells pop up or the bullish warnings pop up, then in that case, I'll look to take action to follow along the lines. The last time a buy warning was indicated or a strong buy recommendation was indicated was essentially around March 18th, I think, of this year. And that's when earnings started picking up 6 to 7 month out long calls on sort of the larger stocks, Apple, Amazon. We mentioned that in our March review of where the market stands now and what we're going to look to go forward. Okay? All right. So that's basically the market indicator. And let me see how far I can go back. So it's been neutral through most of June. Choppiness, as Sam had mentioned. I clicked the history, so it took me back to June 30th. Let's see how much farther I can go back. There it is. That last bearish sell we saw, this is the one I was talking about. It got up to 8. So 6 is still a sell warning. I think 7 and 8 are the bearish sells. And that's when we were at 32.32. And after that, what did we do? We dropped down to 3,000. It started to climb back up again. And then, of course, we started to pull back down again below 2,900 shortly after that. It went back down to the 3,000s again. So that was the time here on 6/8 when I added extra protection to the portfolio, considered adding extra protection to the married put positions that I had open, and might have closed some of the bull put credit spreads as well. That's the indicator that I'm looking for. Yes, we had 4 or 5 days in a row. We had a small pullback, but it was very small. It was only 60 points. Significant, but depending on your exposure, you'd have to judge on that how much protection or adjustments might have been required. This was a much bigger move when we saw this indicated when we went 8, 4, and 1. Okay, so that's just some discussion there on that. I don't think I can go any further back beyond that in the history. If I was logged into my actual account instead of this one, we could, but we do have webinars that go more in depth into that. You can just go to Power Options and look up the help video on the Market Sentiment Tool. Let me just show you there. So I go to View Indicator Details again, and you can just click on the Help Videos button here up at the top. And that'll give you about a 20-minute walkthrough, sort of what we just did, but with some further back-looking view of the indicators as well. Okay, and that's something we can look for there. Okay, so let's see your second question. Weekly naked puts, could they also be used as potential buys to go long stock? Then I wouldn't necessarily do that, and here's the reason why. So let's go ahead, and instead of going to the weekly picks of the day, I'm going to go back into the naked put search. So what he's referring to is that under the naked put tab, we have the monthly picks of the day and weekly picks of the day that Ernie tested. Those are also available under the covered call screen. It shows you the top 2 or 3 in this simple looking view. Okay, naked put, let's go to search, because the default criteria that are used for the weekly and monthly picks of the day are listed here as well. So we see things such as Tapestry, Zscaler, Hess Corp as well. Why, if this is appearing in a bullish strategy? Am I telling Vin that I don't know if these would be a good choice for stock purchase instead of the naked put trade? And the reason why is because we are using some fundamentals and technicals for this naked put screen. We're looking for an average stock volume of greater than 500,000. We want stocks to be in an uptrend, and we want the stock price to be between $9 and $200, just for the margin requirement, and an earnings per share growth of greater than 5%. To tell you the truth, if I was going to buy a stock outright, and the only time I buy a stock outright is if it's non-optionable. Most of everything I do is on optionable stocks, and it is with options trades, including married puts and collars. That's when I'll buy the stock. But if I'm just buying a stock outright, it's because it doesn't trade options. Otherwise, I'm doing options plays on the securities. In any case, if I was looking to buy a stock, I'd be looking for a lot more, probably technical and fundamental indicators, because I'm not looking for a stock to stay the same or move up 1 or 2% in the next 6, 7, or 8 days. When I'm buying a stock, I'm looking for something that has potential growth 30, 60, 90, 100 days, 200 days, a year out in time. I'm looking for a longer term hold, in which case I might look for a larger market cap. I might use a PEG ratio, maybe price to book. In the technicals, I'd probably be looking for maybe over 1 million shares per day instead of 500,000. I might be looking at the bandwidth right now of this as well, or looking for stocks in a certain percent of 52-week range or with a certain MACD. Probably more along the lines, if I was buying a stock, what I might do is a mix of the fundamental criteria that are already plugged into some of our default long call screens, such as the Bollinger Bands. Looking for a higher percent Bollinger Band 20, stocks at the upper range of their Bollinger Band. As I mentioned, the 52-week range. What I also might use, I believe, is in the initial value screen, is looking for stocks that are driven by more stronger growth. I might be looking for an earnings per share growth of greater than 15 or greater than 20. And again, there, see, we're using the PE ratio here and the PEG ratio. A combination of those, Vin, with what's shown in the naked put and what's shown in some of these long calls is what I most likely would use to consider buying a stock. The naked put screen is a good screen and has been successful, but of course, different market conditions might lead to different success rates based on, as Sam mentioned, the toppiness and the choppiness that we've seen in the markets recently with the Market Sentiment Tool and more. But again, I want to look for something that's longer term. I want to look for something that's more technically and fundamentally sound if I'm going to buy it. The naked put screen is more designed looking for stocks that over the next 7, 14, and the bull puts, over the next 10 to 14 days, have shown signs of being stable to neutral, potential for an increase or moving up in price, but it's not trying to target stocks that you would expect to grow 3 to 6% in the next 20 to 40 days. Okay? That's what I do with the radioactive trading technique. One of the reasons why we use those IBD combined lists when trying to screen for the married puts that match our criteria is because when I open a married put position, I'm looking for the position that I have the sentiment might potentially move up 3 to 6% in the next 20 to 40 days. Because I want more of that growth in that situation. Okay? So, again, I wouldn't say that the covered call screens or the naked put screens, they are looking for bullish criteria, Vin, do not get me wrong. It's just that I haven't tested it and I can't tell you if the types of stocks that match this, because we're also looking for a lot of option criteria that has to match that as well. I can't tell you if that leads to a good bullish stock position over a 20 or 30-day period. It's more looking for stable to neutral positions with a good probability and the proper return as well. All right. So that's sort of what I have for you there in that case. And this is going to lead us into, okay, see, Pat, your questions are coming up, and then Pierre as well. Pierre says, what length of time do you use for a covered call? Well, in general, it comes down to your goals. So as I mentioned, we have these weekly covered calls and monthly covered call picks of the day. What are these based on? It's based on Ernie's extensive testing on this criteria, testing dozens, hundreds, Pierre, of different criteria in this case. But again, this comes down to the individual investor. For your goals, for your needs, whether it's for needs for premium, whether it's needs for return, what best matches what you want? A weekly, where if I'm looking on Monday, Pierre, to open a weekly covered call, that means I only have 5 days to expiration, I might only be looking at a 1 or a 0.8% yield, which is great for a 5-day trade. You're going to get a very high annualized return. Always get a higher annualized return in theory selling week by week by week. But you take the caveat that you're getting lower premium up front, though it will lead to a higher annualized return in theory, and that means a lower downside protection and a lower return. If you're more comfortable seeing positions, monthly picks today, if you're more comfortable seeing positions that offer closer to a 12 or 15% downside protection while still giving you closer to a 2.5%, 3% return, you'd want to go monthly. It's as simple as that. To answer your question directly, what length of time do I use for covered calls trades? I don't. I haven't traded covered calls in several years. Only times I'm doing structure similar to a covered call is in the protected married put format, going forward in time with the put and then using the call to help lower the potential at risk and earn premium as well, or as a standard collar position. I don't trade just covered calls anymore. If I like the premium, I'm doing it as a standard collar that's probably 14 to 21 days at a time. The other time I sort of use a covered call structure is in the context of a married put. I just don't trade covered calls by themselves anymore. All right, so that was just led sort of into it, but what this really leads into now, of course, is going into Bernie's question. And Bernie, I do apologize. I did get your email. So Bernie says, good afternoon, Mike. I sent my questions this morning so you could be ready for this afternoon. I was actually trying to answer you this afternoon. I wasn't going to get a chance to put the webinar together today. I had a couple coaching sessions and other obligations. So let's not worry about that. But this Bernie had asked us a couple of weeks ago, and I just alluded to this earlier, back in March. We had done that quick video of market guidance where we were discussing where does the market stand now, what is Ernie kind of trading, and Bernie asked sort of, well, can you do that now? And one of the reasons I hadn't put that together yet, Bernie, is because I honestly wanted to see what happened in the last 3 days. Not to, I don't want to say I didn't want to put my foot in my mouth, Bernie, but what I was really hoping to do is get a gauge of the GDP results that were released this week, rather than going ahead of time and saying, oh, it'll probably be fine. It might be a little down to 3 or 4%, and then here we are down 33%. Okay, so yeah, I didn't want to look like a fool in that case. I was trying to play it safe. I also wanted to see some of the big names earnings that came out this week, not just the tech stocks to see how they performed, but some of the oil companies that went this week as well to see where those stands. That helps give us a better gauge of actually where the market is going. I didn't want to really speculate too much before that. So that will be coming out probably next week for you. Now that I've cheated, the market has given me some indications of where everything sort of stands. But Bernie's other question was related to the fundamentals. And I've already just kind of gone over this with you, Bernie, to answer Vin's question. So what Bernie wanted to know is, what are the top 4 or 5 fundamentals that you or Ernie would look for? Okay, so for bullish strategies, let's go back to just the long call search there. If I'm looking, let me just do this. I'll take sort of a 2-for-1. Okay, I'm going to go to covered calls instead, Bernie, but we're going to discuss this. So going back to the comment we just had about the time frame of the covered calls, I'm going to create for you, I don't know how it's going to perform, but I'm going to create for you just a basic covered call search. And I'm going to go out, this is a cheat, but it's good. I like to go out 14 to 25 days. Standard August expiration is 21 days away. I might go 14 days out too to see some weeklies. If I wanted, okay, let's just do that. I'll do all expirations and we'll go 11 to 25 days out. Okay, so I'm going to look at anything that's a weekly or standard August expiration in this case. Now for right now, I'm not going to worry about our options criteria. I'm going to go into the fundamentals. Now, based on my account, we're going to keep it simple. I'm only going to go 10 to 150. Okay. Basic general criteria, fundamentals I would use for a bullish position. We'll cover fundamentals and a little bit of technicals here as well, is exactly what I said. If I'm doing a covered call, a naked put, bull put credit spread, a calendar call, a bull call debit spread, a married put or standard collar position, anything that's sort of neutral to bullish in this case, I'm going to look for stocks that have a good reflection of earnings. The idea being that the earnings is a reflection of good management and is driving the price of the stock. Okay. The price to earnings, I might keep that. Sometimes I use 0 to 50. That's not really important. I try to avoid the fly-by-night. So under market cap here, I want to look for maybe something greater than 2 billion or 2.5 billion to go mid or large cap. This field is measured in millions. The reason why I hovered over is so that you could see that it gives me guidance whenever you hover over a filter of what you'd want to use for a certain range. So I'm going to look for greater than 2,500, 2.5 billion over above. A covered call, naked put, bull put credit spread, calendar spread, collar. I'm going to avoid earnings between now and expiration. That's not really a true fundamental. That's just something I want to avoid burning. Okay. To the technicals, neutral to bullish. What do I want? I want a good average stock volume. We'll start off at 750,000. I want to see a stock in an uptrend. And since I just chose for this particular covered call, Bernie, looking for a stock price to be greater than the SMA 20. I'm sorry, I rephrased that. Looking for 11 to 21 days, I'm going to look for stocks trading above the SMA 20. And I may even look for stocks, this is going to kill a lot of results, but I'm going to look for stocks that at least have a positive MACD, where the MACD has crossed the signal line by at least one day. These three here are a lot of the ones that I use for the bull put credit spread screen, the weekly bull put credit spread screen, the SMA average stock volume, of course, avoiding earnings, and the MACD crossover. So earnings per share growth, maybe a price to earnings ratio, good market cap, avoiding earnings with these income strategies, positive MACD cross signal, stocks above the 20-day moving average, good average stock volume. Those are probably the most important, I feel, for fundamentals and technicals to start. If I'm looking for a larger movement, notice we were just talking about the neutral to bullish positions. I want stocks that are neutral to bullish. If I'm looking for a larger movement, buying a long call or buying a stock as we just covered for VIN, that's when I would likely use the percent BB20, the Bollinger Bands, to look for something that's near that higher range to try to isolate more stocks that have recently had a Bollinger Band breakout. Now, to go back to Pierre's other point, let's say I'm 11 to 25 days out, so we're extending from the 5 days, so I'm going to look for a good return if assigned of at least 2%. But I still want a good downside protection of at least 5%. Not going to worry about implied volatility, don't need any of that. I'm not going to worry about strikes in or out of the money right now for the call, because this percent if assigned and downside protection is going to help me isolate to at to slightly in the money covered calls, I believe. And at the same time, I'm just going to look for some basic volume. 10 contracts traded today, at least an open interest of 100. What do we get here? We get 23 results. So I just narrowed the entire universe of optionable stocks over essentially a 2-week expiration period to only 23 results. I shouldn't say positive yet. We don't know. And I've got some I've never seen before. Darden Restaurants, I don't know them. Alamos Gold, we know kind of what they do. Brunswick Builders, Newmont Mining, Dick's Sporting Goods. Where's Apple? Where's all the big names? Well, first, a lot of them are removed because of my cost basis. A lot of them are also removed, not Apple, of course, not the big ones that reported this morning, but remember, because the recent fall, the last 2 days, the recent hesitation, toppiness, not a lot of stocks right now are above their MACD cross signal. The big ones are, but they're isolated out because of my cost basis. Let's just take it out. Oh, and of course, they might not have price to earnings ratio as well. So now we got Kansas City Southern. We only increased it to 29 results. So even some of the big names, they're not matching the criteria for what we were looking for. And that could be related to the price to earnings ratio. That could be related to the earnings per share growth. It could be related to, I doubt, option volume and open interest as well. They just had earnings, so that shouldn't be a problem. But you see, everything goes hand in hand. So I can't say these are the best covered call positions out there. I can say that these are the covered call positions that best match my goals for the fundamental and technical indicators I would use to look for a neutral to bullish position. And if I was looking for something that was, I needed more growth for, as I mentioned, the long call or the married put position, I might look for that higher earnings per share growth instead of just those as well. And for the bearish positions, I would just reverse it. But that's what we look for. Now I'm going to go back here because this is related to what I wanted to talk about briefly with Bernie, but it also goes back to William. William just asked, hey Michael, for the market sentiment, does it just look at SPX or can it also measure the market sentiment for the NASDAQ? We are just looking at SPX. And the reason why, and it may be a fault of ours, but I bet you it's not going to be too hard for me. No, well, it'll be impossible for me. I'm not a programmer, William. But it may be possible just to take these same indicators and look at NDX as well, so actually have two market sentiments. When Ernie first started putting this together, and he tested probably 60 to 50 different indicators to see which ones gave the best signals of a market change historically, he settled on these 13 that provided the best indication at that time. So why was he looking at SPX? Because at that time, it was about 7 or 8 years ago, before that, I believe. I'm sorry, my apologies, is a little bit before that. But the NASDAQ wasn't really a true indicator yet of where the markets were. There's a lot more production that was going on, physical products as opposed to tech. Yes, I know there's a lot of physical products being built in the tech, but you know what I mean. The ones leading right now, you know, Apple produces things, but Google doesn't really produce anything. Facebook doesn't really produce anything. Netflix shares things that they've produced for a subscription model that they purchase from things, but they're not producing a physical product, okay? So the market did change. But why am I going back to here? Because I wanted to share here with Bernie that some of these things that you see here that Ernie found are the better indicators are also pretty close to the fundamentals I just checked. Looking for the SPX gap, setting fences on it where you can read it bullish or bearish based on the gap in the MACD. Stocks over 100-day or 20-day moving average. RSI, not one that I use in my searches, but it's there. I want to pay attention to volatility, of course, but I didn't use that in my screen. New 52-week high or lows, and that goes with the 52-week range we could have used in our fundamental screens as well. So you see kind of here that 3 or 4 of the indicators that I mentioned are also indicators that are being used for the market sentiment tool that gave us the best indication at that time as well. Okay, so I'm sorry, I just wanted to wrap this up here because I answered Pierre's question, and he says, okay, but if you don't use covered call, what do you do for monthly income? Essentially a mix of the weekly bull put credit spreads that we have, as well as calendar call spreads as well. All right, so I'll just throw that out there. But 50, I do some standard collars, of course, which is like a covered call, but it has the protection underneath. I'll do that potentially with a portion of my portfolio that's not already in married put positions. Then I'll use 10 to 15% of the portfolio perhaps for bull put credit spreads with high probability going 2 weeks out in time, 11 days out in time. And then, of course, on that, with the calendar spreads as well. In light of that, Pierre, or in mention of that, Sam says, do naked, his suggestion, I'm not saying it's a recommendation or a suggestion from me, but Sam had commented, do naked puts on an oil stock or airline when this improves, those stocks will go up, or bank stocks. And the banks took a big hit there. I don't think Sam's saying right now do those types of strategies, covered calls or naked puts in that case. I think what he's saying is when this gets turned around, naturally travel will increase and naturally they will have those as well. Okay?